Very good morning. Today I'm going to talk about mutual funds. Uh, all investors, they search of a different platform of investment. One of the most protective format of investment. It's about a mutual fund. You can get a proper return from it. So in that way, we can take the mutual fund as a one of the best avenue to the investor. Here we're going to look the meaning of mutual fund. Mutual fund, it's about organization, small investors, they pool money from the collected money. The mutual fund company, they invest money into different securities. That is a specialty of a mutual fund as compared to other platform. Here in the mutual funds, when the specific security it gives a negative return, the mutual fund portfolio manager they plan about diversifying the risk. That is a peculiar and specific character of a mutual fund. Many of them might visited the mutual fund advertisement. You know about it. A mutual fund it deals about subject to market risk. When there is any fluctuation in stock market, automatically the mutual fund or the value also get affected. Here I'm going to read as well as the tell about the meaning of a mutual fund, an investment vehicle that pools money from multiple investors and invest in a diversified portfolio of asset, shares, bond, other securities managed by professional fund managers. So the mutual fund it's about the money collected from different investors. From that money, the mutual fund company or portfolio manager they invest in different securities, bonds, shares, and as well as money market instruments. When you have a diversified portfolio, there are possibility you can reduce risk quantum of the investment. How mutual fund work? This is a sequence. It highlight how mutual fund it run into organization as well as worldwide. First one, pool money. You have to collect money from different contributors, small investors. Second one, professional management. All collected money we have to invest in a systematic way. That is about professional management. Own units. Each professional mutual fund company, the investment it will be considered as a unit. The investment value, the quantity, they put it in the format of unit. So all mutual fund holders, they hold the pattern of their investment in format of units. NAV value, it's very, very important that shows the value of the particular investment. The NAV calculation, they apply the formula, it's about total asset minus total liability divided by number of outstanding units. From that, you can understand the value of the in your fund, your scheme. That one you can get it. Later, it will be compared with other investment. That is a specialty we can get from it. NAV, I already mentioned, it's an indicator. It shows the performance of your mutual fund scheme. NAV represent a per unit market value of a mutual fund. It's calculated at the end of each trading day and a determined price at which you can buy or sell the units. So each day, the mutual fund company they calculate the NAV. NAV it stands at total asset minus liability. Liability in the sense the liable of a company to pay to outsiders. Asset the investment of the company divided by number of outstanding unit holders. Just putting all the things into the formula, you can identify the value of NAV. If the NAV is high, we can tell the unit holder will get a higher amount of return. The NAV is low, automatically the unit holder get a lower return. The schemes available in the mutual fund, open-ended scheme. Open-ended scheme, the special character is about the fund holder. can enter anytime and exit anytime. There is no specification. Based upon the interest of the investor, they can get into the market, buy the unit or invest in the mutual fund as per their wish. They can exit at any time. Normally, this particular scheme, there is no entry load, especially the exit. At that time, they have to pay commission to the mutual fund company. Open-end scheme, the special features they have put out, buy and sell at any time. I have mentioned there is no entry limit as well as exit limit. Anytime the fund holder can enter and exit. Current NAV pricing. Here the NAV pricing it put out based upon the calculation what we have discussed earlier. No fixed return. Here there is no specification about the time period. Close entered on the interval schemes. Close-ended scheme. Here, the mutual fund investors they can enter at the specific period and they have to exit at the time specified in the scheme. So enter as well as exit it locked with the specific period. It is another feature of the particular scheme, close-ended scheme, available only during new fund offer. When you have a demat account, you can enter into this category of schemes. You can purchase a particular mutual fund as per the specification. You can buy, you can hold it for a specific period. Later, you can return and get back the money. Fixed maturity period, traded on stock exchange, redeemed at maturity. Whatever the money they collect, mostly they invest and they deposit. Into the stock market, out of which they collect the money. Interval schemes, a combination of open and close-ended. This one, the special category, it includes a combination of open as well as close. Can be bought and sold during the specific interval, provide flexibility to the with the structure. Interval scheme, it's a combination of both open-ended and close-ended. The company they decide based upon their wish. Equity growth fund. Equity growth fund in the sense the mutual fund company they invest the collected money only in the stock market. They don't invest in debentures or any other securities. They only invest in equity market. They have put out a different schemes under the equity funds. First one, large cap in the sense big companies there they invest. For example, BSE Sensex it index of top performing 30 companies. So here what the company will do in the sense they invest the collected money into the top 30 companies. That's about a large capital. They capitalize money in a large quantity. Mid cap, the next level companies after the 30 some companies in the middle of the stock market there the mutual fund company they invest they get a proper return from it also in a medium size it has a lot of growth or potential on the base they invest. Small cap fund it deals about the in stock market around 5,000 to 6,000 shares you can look at the small cap the share prices are less, the capitalization, the market share of the particular company also less. So that one, it's about a small capital. There are also the company, the mutual fund company, they invest the money. That is about small cap fund. Multi cap in the sense of the company, the mutual fund company, they skip from large cap to small cap and small cap to mid cap based on the demand as well as the necessity. Other schemes you cannot skip to one pattern to another, but in multi-cap you can skip from one pattern to another. Debt income fund. Debt in the sense it deals about fixed interest to the investors. Whoever invest in a debenture, they get fixed interest from the company. Normally, company as well as a bank, they issue the debentures. Through that, they collect money for the development activities. The money what they collect, the mutual fund, they deposit, they invest in debenture. That is about a debenture fund, highly liquid after the specified period, the fixed interest, you can get it. short duration, corporate funds, yield funds, all are other features and the additional features of debenture funds. Hybrid and money market funds. Hybrid, it's about a balanced, it's a combination of both equity, debenture, as well as money market instruments based upon the company scheme prescribed in the initial period. They do investment. In hybrid, you can switch the risk. When you are having some risk in the specific investment, you can switch, you can shift yourself into some other scheme. That is a hybrid salient feature. Money market instruments such as a commercial paper, treasury bill, that and all are short-term instruments. Here, another short-term instrument, you can get a fixed rate of interest as well as a fixed rate of return. There is a specialty. Some mutual fund company they do investment under that category. They also collect reasonable return from it. Some investors are those who are very conservative. They do investment in hybrid as well as money market fund. Special features, index, I already mentioned the BSE Sensex. They are that is the average of top performing 30 companies average. Nifty, it's about NSE's top 50 companies average. So when you invest your money into the particular index fund, you can avoid risk because the top performers they will not give negative result. Uh, at least you can protect your invested money. ELSS, it about equity linked saving and a tax benefit. Out of ELS, the investor they get a tax benefit. Government they provide a tax benefit, but recent budget government abolished the scheme of saving in tax through investment. That one they abolished. So automatically we cannot get a tax benefit under ELSS scheme. Fund of funds. Invest in other mutual fund rather than directly in shares and bonds. For example, ICICI mutual fund company, they invest in SBI mutual fund. Through that, they can avoid loss. They can avoid risk. That is another better options available to the investor. Dividend versus growth. Some schemes it connected with more and more of a regular dividend to the investors. Some shares it goes with the capital appreciation. You purchase share for 20 rupees. It may be after a year 100 rupees. That is about capital appreciation. Based upon your necessity, you can do investment. That is another special character about mutual fund scheme. This one provide a quick reference guide. It project equity fund, debenture fund, hybrid fund, liquid fund, index fund, ELSS are the main category of investment risk level and suitable to the investors. That one provide a clear view to you. On that base, you can decide which one will be convenient to you. We cannot substantiate all. Portfolio, all category of investment meet the requirement of the people. Based upon your necessity, you have to choose a scheme. For example, young one, they can choose equity because they can tolerate a high level of risk, and when they wait for a longer period, they can get a better return. Debenture, it's suitable to the retirement people because they need a stable return. That one they can prefer it. Hybrid, those who want to reduce the risk, they can go into the hybrid mode. Liquid, when some people need more and more of a cash, so they can prefer about a liquid fund. It about short-term parking in a money market instrument. Index fund, I already told. We are investing in long-term securities. That also a better avenue. ELSS, it's about a tax saving platform. You can save your money. You can save your tax money. All the thing you can do it. Thank you. Thank you so much.